How do you deal with the pressure not to overpay for these outstanding companies? Because there's a section of your annual letter where you talk about your mistakes in the past. Much to your credit, every report you go through various mistakes, and they almost always are errors of omission rather than commission. They're things where you fail to buy them. And it seems to me repeatedly, year after year, the reason why you failed to buy them and missed out on huge returns is because they were slightly more expensive than you wanted them to be. So how do you get these outstanding companies at prices that you can bear?
It's not easy because if I want to be logical here, if I'm going to own a company, let's say for 10 years, that's going to grow its earnings by 12, 13, 14% annually, to get that reward in terms of the stock, there can be a slight decrease in the P ratio, but not too much. Because let's say if you quadruple your earnings over 10 years, but the P ratio goes down from, 30 to 20 times, you don't earn 15% annual investment because there was some P contraction at some point in the future. So ideally, you want the P ratio in the future to be similar to what you're paying. So I'm not necessarily looking for let's say a bargain, a company that trades at way below its intrinsic value. Of course, I like it when I do, but to me, if I can find a great companies and in the future, the P ratio is similar to when I purchase it, if I'm right on the growth rate, of course, it can be a good investment. The danger is that if you overpay a little bit, you kind of discounted a few years in advance the future growth. And also, it go back to Ben Graham to have this margin of safety when you purchase a stock. But like you said, I made the mistake of not purchasing great companies because I wanted that P ratio to be lower than the stock traded, that I missed great investment because of that. So it's to find the right balance of, keeping the margin of safety principle in line, and always at the same time, always trying to see that perhaps if you pay a little higher than you'd like to, the growth rate of the company will be high enough that even if there's a little shrinkage of the P ratio at the end of your investment, you'll still do okay. So if you can find a company that can grow by 20% a year and you lose a little bit on the P ratio after 10 years, you'll probably do okay. So I think many mistakes I did can be Intuit or FactSet Research or Starbucks. I failed probably to see that the growth rate would be much higher than 12 or 13%. I don't remember exactly, but I think in terms of FactSet Research, it was probably 17, 18% annually, the growth rate, since I've been watching it for more than 2 decades now. So it warranted a much higher P ratio than I was ready to pay. So I think that's one big lesson. When you do find an outstanding company, you have to be able to pay a higher P ratio.
I remember, Francois, you writing about, I think, selling FactSet too early and missing out on a 25-fold gain over 2 decades, or failing to buy QuickBook and missing out on a 3,200% return, or watching Fox Factory Holdings soar 500% over 6 years and missing out on that. And I'm wondering, what's the benefit of having this section of your shareholder letter called the Podium of Errors, where you, to use Charlie Munger's phrase, you rub your nose in your own mistakes? How is it helping you other than a degree of self-flagellation?
Well, I think it keeps me humble because you don't have to search very hard to find mistakes you've made. But having this yearly podium of 3 mistakes, it makes me think, usually in January at the end of the previous year, to look up what would I choose the 3 best mistake of the year. It forces you to go back and pass decision, both in things you did purchase and the ones you did not purchase. I think having this section in the annual letter every year, I think it builds kind of a process of always trying to learn from your past decisions. And I think looking at companies that you didn't buy. Let's hope that by studying those, and to the example, a very good example of FactSet and Intuit, you want to be sure that in the future you don't make the same mistakes. So, perhaps, let's say, for instance, there's a Lululemon today, which I think is a great company, but the P ratio is a little high. It makes me think perhaps I should learn from the past mistakes and perhaps pay a little higher price than I would like to. And I hope I can always improve and become a better investor all the time by focusing on those mistakes, but also to learn from those mistakes and try not to repeat them too often.
It's challenging though, because I think of a lot of the really smart value investors who've come undone over the last year. One of the lessons that they learned is that it was okay to pay more. And so they kind of relaxed their standards and then came undone when a lot of very high quality companies plunged that they had overpaid for. And so it's dangerous, right? You can learn the wrong lesson from your mistakes. Can you talk a bit about that? Because this is one of those eternal paradoxes, I think, where it's just difficult, right? Because the conditions change as well.
Yeah. Well, I think Ben Graham talked about that in one of his books, that the biggest mistakes you make is not in a bull market overpaying for a great company, because eventually, earnings will keep growing and the P ratio will get back to normal level. It'll do okay. The biggest mistakes in the bull market is to purchase companies of poor quality, and they don't come back after the bear market because they're not profitable or the P ratio was so high. There has to be a limit to the P ratio to pay. I think if you pay 100 times earnings for a company and the P ratio goes down to 20 times during the bear market, you're down 80%. It takes a lot of years for earnings to grow, so you can get back to 5 times the level during the bear market. So there has to be some limit to the P ratio you have to pay. I don't know what's the right number, but I know it's not 100 times. So bear markets are painful, but sometimes you have to still focus on the company. And as long as the company is growing its intrinsic value at good ratios, probably it's a good time just to stay patient and accept that if you pay, let's say, 30 times earning and it goes down to 20 times during a correction, you're down 33%. But, if you're right on the company, eventually earnings will keep growing and the stock will recuperate all the losses and even more good returns. But if you pay a high P ratio to accept that there is that downside, of course.
You've quoted a wonderful line that Ben Graham famously quoted in a speech of his from 1958 that comes originally from the Roman writer Ovid, I think, from his Metamorphoses. So this is about 2,000 years old, where, as you explained it in one of your shareholder letters, the sun god Phoebus says to his son, whose name I can never pronounce, maybe Phaeton, something like that, who wanted to fly their chariot through the sky, the wise father god says, "You will go safer in the middle road." And of course, the son ignores this, loses control of the horses and crashes to earth and almost destroys the world by setting it on fire. And you've said that you consistently followed the middle road in investing, which I think kind of describes what you were just saying, like how to balance this desire for growth, for outstanding growth, and a desire to pay the right price, not to get too ahead of your skis. Can you talk about that idea of the middle road, which seems kind of fundamental to your approach?
Yes, I think the middle road, there's many ways to see it, but in terms of our investment process, I would say first we look for great companies that grow the intrinsic value at quite high ratio. We don't want the revolutionary companies that, grow 50% a year, but you have to pay a very high P ratio. And sometimes people used to say that more companies die of indigestion than from starvation. So what he meant by that is that companies that try to grow too fast sometimes create their own doom. So we look for companies that grow their intrinsic value, but we're very prudent companies that grow at more than 20% annually. So the middle of the road in this case would be companies that grow their intrinsic value, let's say 12 to 20% annually. And in terms of valuation, of course, we like to pay very low multiple, but even for great companies, we don't pay we don't want to pay too much a high multiple. Like I said, we don't want to experience a P reduction in the future. So again, the middle of the road is to find probably companies that are not necessarily trading at very low valuation, but not too high valuation either. So let's say 20, 25 times earnings. And I think also in terms of market cap, of course, very young companies can grow very fast, but they're more risky. Usually they don't have a moat yet around their castle. So usually you want companies that have a good history of building a moat around their business. Usually you don't get that with very young companies. And with very big companies, yes, they can have a moat, but they're so dominant, they're so big, it's hard for them to grow at high ratios. I'm thinking Procter & Gamble or Coca-Cola, for example, great companies, but, they won't grow earnings much more than 6 or 7% annually. So the middle of the road here would be to find a company that is big enough, old enough that they have a strong competitive advantage, a big moat around their business, but at the same time is not too big so that they don't have any growth prospects in the future. So I think, again, the road applies in our investment process here in terms of size, not necessarily in terms of big cap, large cap, small cap, but really in terms of where they are in their path of growth in the future.
I'd say you also have a very middle of the road approach to diversification, right? Can you talk about how you balance the benefits of concentration and diversification so you have a chance of outperforming, but also are more likely to survive?
Yes. Many of the great money managers that I studied, Philip Fisher, Glenn Greenberg, of course, Warren Buffett and Charlie Munger, most of the time they were very concentrated. Let's say sometimes 10 stocks, let's say, for instance. And they've done very well. And they waited for the right opportunity with a very large margin of safety, and they've done well. But for myself, from my personal experience, I thought that 10 is a little low. And I felt more comfortable with something like 20 to 25 names. So a typical weight between 3 and 5%, let's say, in a single security. And from the almost 30 years experience now, having around 25 names in the portfolio, for me, seems to be the right balance between having enough securities that if you make one or two mistakes, it doesn't hurt too much the portfolio. And at the same time, I think 25 names is concentrated enough so that we're not too diversified. That, the more names you have, the closer to the S&P 500 returns you'll have. So you don't want to have too much names in the portfolio because the odds of beating the index go down very quickly. So I think that's the right balance for us. So again, it's probably middle of the road here. It's the right balance, having enough securities that you have proper diversification, but not too much so they are too diversified.
Another really fundamental tenet of yours is that it's basically futile to make market predictions. You say that people are always writing to you or grabbing you in elevators or whatever and saying, is now a good time to invest? Can you talk about this really fundamental insight that it's just a game you don't want to play, trying to predict where the market's going, where the economy is going, or any of these big macro or geopolitical things that you deem too difficult to know?
Yeah. Well, I never tried to predict the stock market. I think it's unpredictable. And one lesson that was very useful to me, and lucky enough, it was not mistakes I did myself, but just watching other great investors. I won't name names, but I remember a very, very brilliant investor that was a great stock picker, really. But he was very prudent and he always kept 20% in cash. So his investments, the stocks he owned, let's say did 14% annually, but having the 20% in cash yielding close to nothing reduced his overall results to 10, 11% annually. So I observed that and I said, this doesn't make sense. He's such a great stock picker. Why not be 100% invested and just live with the ups and downs of the stock market? And I learned a lot from that. So I said to myself, my goal, my mission is to find great companies, to be an owner of great companies. It's not to predict what the market will do. And when you have some cash, in some ways, you're trying to predict the stock market. You're trying to wait for a correction to invest that 5, 10, 20% in cash that you keep. And I think the odds of being able to achieve that, from my observation, are not that high.
So do you never really have any cash?
No, I don't.
And then when you get whacked in the short term, like we're seeing at the moment, which is a pretty painful and uncomfortable situation, even for a lot of very prudent investors who are getting hit quite hard, how do you deal with it emotionally?
Well, personally, of course, I don't like it. It's not a pleasant experience. I try to always go back to the idea that we own companies and try to focus on what's happening with the companies. And what I try to do is every time there's a correction, a bear market, I try to see if there's ways to improve the portfolio. So I'll sell companies in the portfolio that either are not as undervalued as others, or that perhaps the fundamentals are not as strong as usually when there's a recession. You can see the companies that are strong and those are less strong than you hope for. So I'll try to improve the portfolio because there will be opportunities. With every bear market, there's opportunities. So, and that's what I've been trying to do every time there's a market correction. Probably sell or reduce holdings that either the fundamentals are not as strong as hoped for, or that valuation has not come down as much as the others, and increase the ones that I believe are the most undervalued in the portfolio. If I'm right doing this, technically, when the market do rebound, the portfolio will have improved prospects going forward. So that's what I'm trying to do.
Is there anything particularly dramatic that you've done over the last couple of months where you think, yeah, I've seen some kind of disruption where some area of the market's been really clobbered and I've actually kind of seized the opportunity to upgrade the portfolio dramatically?
I wouldn't say dramatically, but probably we purchased made 3 or 4 trades, either selling or reducing one holding or buying or increasing one other holdings. We've done 3 or 4, and we're thinking of doing more because in the last few days, many of the securities in the portfolio has gone down quite a lot, and some are getting at a very, very attractive level. And like I always say, it makes sense to sell a company that, I don't know, trade at 60% of intrinsic value to buy one that trades at 40% of intrinsic value. And in bear markets, you'll have things like that. So
can you mention one or two things, Francois, that you've been able to pick up that are particularly, I mean, this won't come out for a few weeks, but something that epitomizes what you do? So not so much a stock pick as something that gives a sense of your approach. In a way, what Ben Graham said, that you're making the market your servant, not your master.
Yeah. Well, one stock that we already own for a little more than 2 years is Five Below, which I think is a great company. And the stock went down probably 35, 40% at some point, and we increased it. I think we reduced, I remember we reduced Dollarama, which is a fine company, a great company in Canada. But I think the two were trading at similar P ratios. But I believe that Five Below will grow much faster in the years to come than Dollarama. So probably Dollarama is a little more stable in terms of their revenues and profits. So market gives it a higher multiple because these days the market likes stability. But I think over 5 years, Five Below will do better. So we just sold one that looked a little less attractive and increased the one that is more attractive. Perhaps if I could take another example, one stock that is down 20% today as we are speaking is CarMax. I think it's down to 67. And I believe, I don't know exactly when, but within 5 or 6 years, the company can earn $12 a share. So at 67, if I'm right on that $12 a share, let's say in 2027 or 2028, this is a stock that could triple in value at least. So I think it's a great opportunity. It's already, it's a little lower today in terms of size, but it's already in our top 5 holding in the portfolio. But this is an example of a company we could increase. Of course, the results in the last quarter were a little disappointing, but I know that I've been owning CarMax for 15 years. I know that, yes, it is a great company, but it is a cyclical company. When there's a slowdown in the economy, sales go down, and you have to accept that. But if you have a long-term horizon, I think that's a great opportunity. The stock is down 50% in the last year. I don't think the intrinsic value has gone down 50%.
A lot of your biggest holdings are things that you've owned for many years. I was looking through various old holdings of yours, and I think Berkshire Hathaway you bought in March 2000 at the height of the tech bubble when it was under $30 a share, and now it's got 270 even after, this is for the B shares, even after dipping fairly substantially. CarMax you bought in 2005, Dollarama 2010, and it's gone
I think CarMax was 2007.
Okay.
At a perfect time, just before the 2008 big drop.
Yeah. Visa you've owned since 2010, Google/Alphabet since 2011, Markel since 2013. If you look at the common denominator among these very sort of integral positions in your portfolio, what do companies like that have in common that illustrate what you look for in an outstanding business?
Well, I think all the companies you mentioned have a combination of having great managers, but not only great businesses, but kind of unique businesses. And, the idea of having both is that I believe these companies have something special that gives them strong competitive advantage. But if I had to summarize in one sentence, I believe they have a unique business model. And I mean, Visa is very similar to MasterCard, of course, but I think the two together, they're as great businesses as you can find. I think Google Alphabet is fantastic business it's really dominating our world today. I don't know exactly the number, but they probably have 40% of all ads on the internet or something like that, and directly. I think CarMax is a very unique business. I think they've got something like 4% market share of all the used cars sold in the US every year. And I don't think probably the closer now is Carvana, but Carvana is not profitable yet. So I believe that CarMax has a very unique business model and very well managed, in my opinion, also. And capital allocation is very important in the companies we look for. You talk about Berkshire Hathaway, but we could talk also of Amatec or Constellation Software or MTY Food. I think those 3 companies have a very strong history of intelligent capital allocation. And, if you're going to own a company for 10 years, a lot of your returns will be the fruits of intelligent capital allocation over the years. And that's one very important criteria we look for.